And we are live. Welcome everybody to this month's ITSA panel on venture capital and blockchain. Last month we spoke about decentralized finance and its comparison to legacy banking. And keeping with this trend or topic of comparing a little bit the old world, so to say, with the new world we have now with blockchain, this month we're going to continue a similar discussion, this time of course about venture capital. We're going to speak a little bit about the differences that we see between traditional tech venture capital as well as blockchain venture capital, how these investments are done, what some important red flags or green flags are when compared to other forms of venture capital, as well as just have a general discussion on the state of the market right now. And with me today, we have four fantastic personalities from four different venture capital firms. Mr. Wolfgang Mendel from Blockchain Founders Group, Juliane Hahn from Signature Ventures, Benjamin Horvath from BlockRocket, and Percy Müller from Atommind Group. And I'm going to start with a round of introduction now, beginning with Wolfgang Mendel.
Yes, good morning. Glad to be here. I manage the venture capital business within the Blockchain Founders Group. We are both a company builder and an early stage startup financier. Personally, I've been infected with the VC virus since 2000, following a career in consulting. I lived through the dot-com boom and subsequent bust, the ensuing resurrection, the mobile revolution, and now the blockchain paradigm shift. And it's super interesting because some things have changed a lot in venture capital in the blockchain world, and some things obviously have remained the same. And it'll be interesting to discuss about this with my fellow panel members today.
Thank you, Wolfgang. Moving on with Ms. Juliane.
Hello, thanks for the intro, Max. I'm the managing and founding partner of Signature Ventures. We're early stage venture capital fund that is focused on decentralization projects. So everything around distributed ledger technology in the broadest sense. And I've been in the venture capital space since around a decade now, and basically working in the space from all different sides, like starting as an attorney and as an investor, business angel, and so on. Also, I had some time in corporate venturing as well, and that's exactly why I want to get back into that anytime soon. Of course, also I'm thrilled to have this exchange today because we are still very few in the market that are focused on these projects, and we have some particular challenges also to face.
Fantastic, thank you. Benjamin?
Yeah, I'm the managing director of BlockRocket. We're an accelerator for early stage startups in the blockchain space. So we invest pre-seed and seed tickets mostly. Myself, I entered the blockchain and VC space 2 to 3 years ago. I've spent most of the time before and in between working especially in early stage startups. I've worked for companies like Rocket Internet. I've been abroad several years in like different markets. And we specifically focus on, so we operate in the blockchain ecosystem and environment, but since we're very early stage, we focus, of course, mostly on founding teams and early days, achieving product market fit, and the challenges that relate to that for founding teams mostly.
Okay, and last but not least, Percy.
Yeah, good morning, ladies and gentlemen. My name is Percy Oliver Müller. I'm the CEO of the Atommind Group. And my background is relatively simple from the IT consultancy realm. So I hopped into many business disciplines. From that, I picked up a lot of the pace. Finally, I made myself independent and I decided to spend my money on some interesting startups. That's how Atommind has been founded. And we are definitely envisioning a lot in the blockchain chain realm. And I'm very proud to be part of this panel today, and I think we will have a lot of interesting topics.
Thank you. We're glad to have you. So as most of you mentioned, you have had some background in venture capital before you moved on to specialize more into blockchain. So I think one of the first things I would like to touch on is what some of the biggest challenges are that you face when focusing specifically on blockchain investment. And I would like to start with Percy, since you were the last to speak as well. What your opinion on that is?
Yeah, it is literally simple. The blockchain is now the most important missing part in automatizing most of the financial business because it's a heavy compliance related thing. And it took a while till the people understood the capabilities of the blockchain in that term. And now the first round is over. We are now over the early adoptions realm. So it went over into the productivity. We have many applications that are now in production. And that means that blockchain cannot anymore removed from the world. And now it's the time for the investors, because we are more safe now. We are also safe from regulation and so forth, because it's now widely understood from the regulatory bodies. And based on the blockchain, with the combination of AI and the securitization aspect, this is now the dawn of security tokens, of the non-fungible tokens and so forth. So finally, a lot of value is now moving into the blockchain, being securitized there, notarized there. And now all these mechanisms are widely understood. International courts are now accepting these things as a decision when it comes to different disputes. So that is also being taken care of. It's a pretty interesting thing, and I think that is why we have the motivation and the endurance, by the way. I mean, it took us a while before we made any significant return on invest. And now we see that immediately at multiple points, we are seeing a great potential of return. So I think that our patience and, as I said, endurance is paying off.
Fantastic, thank you. A lot of things to unwrap, and we will certainly touch on regulation as well as tokens a little bit later in the panel in more detail. For now, I'd like to move on to Wolfgang and ask you what for you are the biggest challenges, and also maybe the biggest opportunities that come with focusing on this particular field.
Well, there was a whole new, so to speak, vocabulary that I had to learn when moving from traditional venture investing to blockchain. I mean, all of a sudden you had things like ICOs, you had tokens, you had coins, you had protocol level, you had application level, and all that is very different from the old world. I mean, so far we as BFG have only been investing in equity. I have a lot of respect for token investments, because you really have to understand the underlying technology in depth, obviously understand the tokenomics, and there are many things that are completely outside of your control. Whereas if you invest in equity, at least you think you have a bit more control. So the whole idea of investing not in equity but in token, and into a thing where you do not become necessarily an owner of the business where you're investing in, where you cannot be part of the governance process. That is something that it takes some time to get your head around. And I mean, we've been discussing this for a while, to be more daring in the token space, because tokens obviously have great returns, but I mean, there are a lot of scams in that world as well. And I would expect that probably 99% of all models will eventually fail. And that's fine, because if 1% turn out to be great unicorns, that's a great result for all investors. But that for me personally was quite a big hurdle to jump over initially, to understand the new world of investing in blockchain.
Okay, understood. Yeah, it's, I think, very interesting to see what you mentioned as well, that there are you know, a lot of things happening, but we're not sure which ones of these will last in particular. Juliane, what are your thoughts? Is there something maybe very unique that you found that really separates blockchain venture capital from your previous work?
Yeah, there's a couple of aspects to it. So first of all, I think if you're thinking about distributed networks and the impact that it has on the digitization level that we currently have or had before, it is really necessary to rethink completely. It's a big socio-economical change. So the typical business model that you had before just simply do not always apply anymore. Or in most of the cases, especially when you're talking about infrastructure that is built in decentralization space, it is completely different, because as Percy and Wolfgang already said, if you have tokenomics at the base, it is not easily to access when the infrastructure is built in a seed phase how that turns out later and how profound the thinking is, how mature the entire structure of it is already, because they are only building it and there's basically no one to copy from. So the second point, that leads me to the second point from an entire rethinking. The second point is precedence. You don't have precedence to evaluate those models easily. So everybody who is investing in the space really needs to dedicate fully to see as many projects as possible, to be only able to, I would say, have an approach to assess it that is merely sufficient, other than really thinking everything through in detail, which is the hard part. So it's extreme hard work to really be investor in the space and invest not only the own money, but also having fiduciary duties towards third parties. Then no precedence also means that you do not have a lot of consultants you can refer to, because that brings me to the regulation and the entire legal base for those investments. Everything is unclear. So the kind of investment agreements that we are entering in, they change on a monthly basis. So there's always a new best practice to it. And there are really few consultants, especially if you invest internationally, that cover it. Especially in Europe, there's just a few names you can go to that have a deep knowledge in the space. If you can talk about deep knowledge, because it's all evolving all the time. And then the third big topic in my opinion is that is a very closed space. So to have access to the deals is not easy. You really need to be in a space, you need to be active, and you need to be seen. But on the flip side, of course, the opportunities are super large. Just to name it, I mean, the blockchain VC funds have significantly outperformed the market over the last year. So the opportunity is clearly there.
Right, so typical higher risk, but also higher reward ratio. Benjamin, how about you?
Well, I would argue, especially from our context, because we are early stage and focus mostly. I mean, we have many teams in our deal funnels that don't even have an MVP at often, right? Like often an idea in a team, and it's that early stage that like most of those teams are like far away still from product market fit. So I think in general, like that's one of the biggest the challenges that early stage startups have in general, independent from blockchain technology, like yes or no. Is like, do you build on a hypothesis that's a use case that actually solves a problem that someone else is paying to pay for? And I mean, from our lens, of course, that's generally one of the hardest parts of a startup in its lifetime. Many successful startups have to do actually a few pivots like along the way, like before they hit product market fit. And I think with blockchain technology, it's you have this extra layer of complexity. Like I think the problem with disruptive technologies is that it also it's very hard to predict the future. So it is very hard to predict, okay, like what emerging trends we have in terms of specific use cases in like 10 or 20 years. And I think that makes it like extra tricky for startups to achieve product market fit. I would argue from a startup's perspective, what makes it even harder is that like, so some STO, some ICO projects, even if it's legit ones with good use cases, I would, for example, argue that it is maybe even a challenge, or it could be dangerous if they have too much money up front with this new form of financing, because I think actually it is healthy for a startup if it does not have product market fit yet to have a certain scarcity in terms of resources, because it constrains them to really focus their entire attention on, do we have a product and use case that achieves product market fit before we actually scale capital, like to scale up operations. Because otherwise, I think you have this risk as a startup to try to fix a solution where there's not really a problem. And this is also the stereotype that comes along with many blockchain use cases as well. And I think which is certainly related to that. So for us, so as teams, product market fit, how they and how much are they really in touch with who is actually the end user of their product at some point, and how do they respond to that?
Fantastic. So I've heard a lot of challenges, product market fit, the lack of best practice, kind of uncertainty when it comes to some forms of regulations as well, very early days. And Benjamin, you've mentioned maybe a first hint of something that you do to mitigate those problems or risks? Like you said, hey, I believe it's maybe actually better if there's more scarcity. And I would like to ask the round in general, how do you deal with those particular challenges? What are the kind of steps you try to take to overcome those challenges and really make the most out of the opportunities that present themselves to you? And maybe Benjamin, you can keep going.
I mean, we are in the comfortable, firm position that we do not do from our side token investments at this point. I mean, I only do it in private context, and I think it's good because as Wolfgang was, Juliana already mentioned partially, this is I think an art or a space for itself. I think the way you do a due diligence probably on a token related project can be very different than from a classical startup team from your garage that's raising 100K. I think, and you can see this in the valuations, right? Because many early stage projects that do an ICO have significantly higher valuations than maybe a conventional equity based early stage startup has. So from our side, I'm not an expert yet, or from a VC perspective on how to do token investments. That's why we clearly say we focus on what a conventional approach of equity investments and early stage startup deals. And there is this type of scarcity. So that's the types of deals that we invest in. As I said, I do think for us, it seems healthy because then startups are really constrained by the financial resources to really focus on, they're in constant survival mode, right? They have to go from funding round to funding round within 12 to 18 months, and they need to deliver on KPIs that resemble at least some sort of product market fit. Series A upwards then is ideally product market fit. And it's at least something that I observe in our context that I think is quite good. But of course, there's also proven ICO cases that can work. But I think maybe the others have more to talk about that.
Yeah, we've also, if I may just add here, we've also seen quite a number of business models where you talked about equity investing, and then the team came up with sort of an ICO component that was bolt onto the side. Which not really made sense in a business context, but sort of was a way to show that they could raise 100 million. And you are sort of wondering, I mean, what kind of world are we living in? It's like, I mean, back then it was you add .com to everything and the valuation triples. These days you add ICO to something and the valuation grows up 10 times. And you really have to look behind the scenes to find out if ICO makes any sense for this business at all, or a token model, or if it's a blockchain or a DLT based model that can be and should be financed with normal equity. Juliane, I think you also had something similar.
So yeah, many good points. We are mostly equity focused. And I think this is something that people often misunderstand, because what means to be mostly equity focused? We are only investing in or doing token investments if there is no other way to make sense of an investment structure other than with a token. So that means that most of the projects that are mature enough to really mint tokens are in a stage where an infrastructure is running that needs a token. And as we are talking about communities and open source projects, where the core team basically somehow diffuses in the community at some point, ideally, the value then lays in the token. What we see is exactly opposite. These are not most of the projects. Most of the projects that launch tokens, they are just, and this is probably a prejudice that we have developed over time, because we see so many projects that do it. They are just not ambitious enough to deal with all the VC questions. So what we had a couple of times was we had promising teams that we were having a deeper look at, and they had originally a really great idea. They had understood, which also has been shown by an interesting study that has been presented at Web3 Summit like 2 years ago already, that building a project in the very beginning is very, very similar to normal company building. So you need a very dedicated team and you need dedicated supporters. In the best case, we see investors that are very supportive to provide you with network and to provide you with knowledge to explain you all the details that you have to deal with when you have employees and a payroll and a more complex growing structure in the company. You need to align the team and so on and so on. So all the challenges typical VC faces every day. And they basically then figure out that VCs sometimes have a lot of questions and it's very frustrating. So there are a couple of people that just recommend do a token launch. It's way easier. And then in that very moment, they figure out that the valuation sometimes triples or quadruples. And they think like, oh, this is a good thing to do. But we have a lot of projects, I won't name them, but I think most of you will have a rough idea in which direction that goes, that exists like a couple of years now and that have very early on launched tokens. And they really have to deal with the community today that is not satisfied with the progress of these projects. And they had really big brain drain within the team because of all these fights and struggles they have to face now. And the team we invest in, to wrap it up, are now mostly teams that start on an equity base and say, once we're ready, and that go all the way. And then once we're ready, we'll do the token launch. And it's prepared usually for even years. And those are the teams we are very willing to invest in. But always like really give us a clear reason why you're doing the token launch now. And it's just not smart on the long run to have an easy start that way and then having to face and having to realize that reality that you created, that you're worth 50 million without having anything, and to struggle with the community all the time. Most figure that out the hard way.
I can add on to that. So literally from the perspective of the venture capital, we have to protect, of course, our investors. We are not alone in this field, so we have shareholder responsibility and so forth. And what our approach to that is diversity. So we built a very diversified portfolio. Also, we mix it with startups that are not so completely blockchain affine, so that are actually in other disciplines, but later cater to the ecosystem. Also, we select the startups that we are investing in, that they are fitting together, so that we are literally building a complete package of solutions, strategic positions that we can take in. And by intercombining these things, we are building platforms and common things. We have like an art trading platform, for example. I'm currently in Milan on the art fair. And that was a very good example how this went, because blockchain was just focusing on protecting art. And all the ICOs that are focusing on protecting art, they went out of business because the art scene doesn't want it. They don't want to audit their paintings and being identified as forged and losing a lot of money, because it's a different mentality there. So now with non-fungible tokens is a different thing. So all out of a sudden, it comes back to the NFT space that gives a much better approach. But also now, the problem is it's already kind of a red ocean situation, because people can use NFTs by themselves. It's like the same as the opening of the audio markets, where people became publishers and streamers, and the record labels went more or less into the realm of unimportance. So the approach from the venture capitalist must be in multiple ways, and that is in first of all diversification. But also, it's not enough like to go to a startup and tell the startup, hey guys, you are under, we are giving you money, and we come back when you're ready. That is the ideal case, of course. You can just sit back as like normal investors. So that's why I see token investment here as the abstraction layer in between us and the syndicated investment of other people that are invited to it. But literally, you have to provide to the young teams also kind of a basic infrastructure. So on top of that, we have built an incubation center. And the incubation center also has a response team for emergencies. We have a backup IT monitoring center, and so forth. So you have to do a lot of investment to your own infrastructure as a VC fund. You literally become a software house itself. So it's not only about the classical approach of finance, where we just do due diligence, compliance, securitization aspects, syndication aspects, and investor relations. We are now talking about the combination of all of these disciplines. That's challenging and also hell of exhausting. And as Juliana already rightfully said, sometimes you are with one of these startups for several years before you make any offering. And that is what you need. You need a lot of contingency in that, and also liquid cash. That is sometimes not, it's inevitable in this realm, but I believe it's paying off now.
So would you say that the typical investment cycle you have for these blockchain firms before you can exit, and even if a token sale means exit for you or not, do you think it's much longer than it would be on a tech startup that is not maybe blockchain focused?
The answer is you need money ASAP. The problem is the problem is that many startups that just immediately launch a token, and they do not even know what this token does. This is burning a lot of reputation. So if you be behind it, and we put it a strong brand behind it, then we can do that because we have a lot of possibilities to mitigate that. By we have built tokens called accredited that's soon to be launched. It's a combination of, and then here we have also the other discipline. If we do token investment in general, we are in the token realm. We have also a trading desk that is taking care over the leverage, also tries to manage the standard currency risk. It's actually the same as an oil trading company that does international oil trade, where you have to look on all these currencies. It's the same thing. You have a book of crypto, and you have also a book of tokens. And this will be managed by a kind of a central thing. But what I wanted to say with that is that once you have these infrastructures in place, you can launch a token if you offer the investors a way to cash out. And that is the biggest issue on security tokens when they go OTC, when you are just wallet-to-wallet transactions and they have not really exchanges in between. The problem comes also with the liquidity. If the exchange is willing to provide liquidity for a certain security token, that's a completely different story on top of that. So as a venture capitalist, you have also to provide the liquidity pool in that case. So we have built this ecosystem as well. So Atomind itself built an ecosystem, and again, it's not so much of a story. And they're also available ecosystems. I mean, we got a lot of relief because there's another risk, which is, for example, the increase of gas prices. I mean, Ethereum is literally exploding. We have a lot of relief from Hedera. We are using Hedera Hashgraph to also mitigate that. So you need to be constantly updating yourself, and you need to go as a venture capitalist into the blockchain. You have every morning you have to wake up and learn new things. Otherwise, you're out of business very soon. And also you see how difficult it is to maintain within the right talk, you know, to have all the terms that are changing every day. So the transparency is also an issue. I mean, that is why it's called venture capital. It's also at venture capital. And literally after a lot of stressful time, I can say after it's paying off, it was worth the hustle. I mean, people climbing mountains nowadays. And I think we have literally made it half up to the top.
Okay, interesting. Thank you for that perspective. So it seems like you are very, very much involved actually with some form of token investments at least, and that is something that you strive to do in comparison to the others. Now, one thing I've noticed is that I think, and correct me if I'm wrong, all four of us sitting here, or all four of you sitting here, are actually focused on seed and pre-seed investments. And I would like to maybe hear your thoughts on that, what the reason is that you've decided to go for this particular stage. I think, Benjamin, you've mentioned already that you like to have this very team-focused approach that you have there. Maybe some other opinions on this.
Yeah, I'm glad to. Sorry, were we addressing Ben or just open?
No, Wolfgang, please go ahead.
Okay, I mean the reason why we do seed and even pre-seed is fairly simple. We think that the Series A space is utterly crowded. And there is so much money out there, and the valuations are just crazy. So you can really play to your strength, regional closeness, having a great network in the seed round. And one of the big differences between an ICO and a VC, because I guess that's something that many startups will think about. Should we do an ICO or should we go and see a VC? I mean, venture capital seems like a lot of work, and ICO seems easy. That's at least the common perception that we see very often. But when you raise equity, not only you have the chance to refine your business model through probably many rejections and sometimes encouragements from VCs that give you guidance, but you also have a direct connection. Like ICO to me seems like a B2C model. I mean, the money is raised by individuals, whereas with venture capital, the money is raised from corporates or from funds or whatever structure there is behind. And that is a big difference, because with a VC, you have a dedicated partner or partners, because most of the deals are co-investments anyway in the early stage. There is a lot of trust. There are people rooting for you that will use their network and their experience to help you in any way they can. They will help you getting in touch with your first customers. They will help you recruit new managers to the team, or even help co-founders. And all that is not the case with an ICO. An ICO is basically an anonymous construction, whereas venture capital is something which is built on trust. And yes, you have to give up part of your equity. And obviously the advantage of the ICO is that you don't. You stay a full owner of everything, but it's by far not the same thing. If you have any problems, I mean, you call up your venture capital firm. You can't do that with an ICO. So it's a completely different world.
So it sounds to me right now like the general opinion here is that really an ICO, especially when it's too early, just makes a lot of problems for the company. Like you said, there's no real point of contact, there's no help. You suddenly have a lot of stakeholders that all have high expectations due to your high valuations. We do have a question from the audience, and they ask specifically, do you see any pros in such a token sale? And maybe also, even after an equity investment, what are the advantages you see from maybe creating a token sale? Juliane, what are your thoughts?
Yeah, very good questions. Of course, there is like even a necessity to it when we're talking about infrastructure. Also, when you're looking at simply tokenization of assets, and not only token sales, but the general idea of a token representing a real value in a digital asset, that you can peer-to-peer transact to a counterpart, and where you have a great possibility also have liquidity in the market and to sell it at any time in a secondary, that creates a lot of flexibility. And that also accounts, of course, for everyone who uses that token sale. Those startups, some of those did great, of course, doing an early token sale and managed the community well. And they really also handled to build a substantial project that is the counter value to the token sale, basically the valuation at the token sale. So it's not always a scam. It's not always something that comes too early. The thing is only that I think the economics behind it, and that would be my general advice for everybody who's acting in the field, whether it's a founder or an investor, retail investor, professional investor. If you don't understand the economics behind it, stay away. Other than if you want to speculate and gamble. Of course, there are a lot of opportunities to make a lot of money. We all know that. Many of us are in the space because of that and not for the passion of the technology. But if you really want to be successful in the long term and not depend on a bull and bear market short-term trend, then it makes completely sense to deal with the economics. And always, if you have a full assessment of that, you can make a decision: is it smart that the token is applied here or launched here, or are they too early, or doesn't that makes sense at all at this point in time. That would be my general advice. But that is a lot of hard work, really, to get into that. And it takes a lot of mathematical understanding and of those concepts. So it's not easy to tackle for everybody. What some do, this is also an interesting idea, as I find, and this is the great advantage also from the investor side or from investors' perspective of those tokens. You are not depending, as a retail investor, you are not depending on meeting the regulatory hurdles to invest in VC fund. They are quite high. So in Germany, for example, it's 100K at least that you have to invest in a structure like ours from a regulatory requirement, as semi-professional, even 200,000K. So if you are copying a portfolio of one of the very successful investors in Silicon Valley, you have access to these tokens. You can basically be your small A16 set, for example. And that is a great opportunity for retail investors. And that is a side about token launches that I really appreciate because it democratizes the VC idea in a practical sense.
Maybe if I just make one sentence to build on what Juliane was just saying. I mean, obviously the advantage of an ICO is you're not bound by any geography. You can move very fast, and most of all, you don't need a working product. It's as we said during a recent discussion, it's the exit before the MVP. So it's, I mean, how does that sound? It does sound tempting. Or the reality, personally, you're probably gonna jump in here. Reality is obviously different, but some teams have gotten away with it. No product, nothing, and they raised 100 million and more.
But then we're talking about like what but then we're talking about what we're optimizing for, right? Because I would always argue, I think the best, like that's in everyone's interest, is to optimize for long-term value, right? Be it for the users and for the investors. And I think that's something that, and that's maybe also ties back to when I said in the beginning, like from my standpoint, I think it's a bit unhealthy for many companies actually if they get too much money before they achieve some sort of product market fit, or they get challenged by the restrictions to achieve product market fit to be able to survive, that they start building some solution. Either it's, I mean, there's scams, sure, but there's also good projects with good intentions that kind of sit for years in like their garage without like losing touch to the reality because they just have too much money from an ICO, building things that in the end no one maybe is ending up using. And then I think, so the long-term perspective, I think, is something that a lot of founders are actually missing. So like, I think generally, I think people optimize short-term over long-term. And I think if we want to optimize for long-term results, then I think there needs to be some sort of connection between the two. And otherwise, what I also want to say, I think, and Giovanni, you've already touched on this. I think that the tokenomics is essential here, right? Like, what is actually the use cases that are built around the tokenomics of a project? And I think that, like, is it just some startup that could actually also be equity based, and they just have a product and a token? And that's something that we can observe with like hundreds of projects if we actually read through the white papers. Not all of them are building like fully decentralized ecosystems. Many of them try to become centralized companies with some product feature that runs on a token, which is completely different than saying you build an entire infrastructure like an Ethereum or like a Polkadot that says they have a token-based system that, like, the token itself fulfills like a variety of different functions, and you want to build an ecosystem where other platforms can be built on top of that. So I think we also need to differentiate those business cases when we analyze a token.
Totally right. I can just underwrite it. Most of the time, if you are addressing inexperienced investors, they need to understand that we have to return to the point where we were talking about utility tokens. And a utility token means nothing else that it is a raw material on a virtual infrastructure. And if there's a demand for that virtual infrastructure, then you need the raw material to run it. This would be good for cloud services, blockchain services, gas, and so forth. But if we have seen companies that brought out utility tokens for like a vacuum cleaning robot that wanted to buy new bags for it, I mean, we have seen with Air Berlin, they went out of business and your top bonus card is just been erased and all the miles you've flown are gone. That's the same story with utility tokens. You do not know if that infrastructure that they have built makes sense. If they're even building it, they just probably did things. And those that raised 100 million were mostly companies that actually, even if they didn't have any working product, had a very good public relation team or even have been PR agencies themselves. But we have seen a good self-regulation in the market, and we have seen also that also now law enforcement responded to these bear sales. And we see that also in the United States, especially, the SEC has hunted a lot of these ICOs from the past down. Many of them are refunding. Some of them are even in prison right now. So it's not that easy. You can be immediately declared a security anytime, even 10 years back. So the problem is communication here. You need to, as an ICO, if you want to make a token sale, you must convey as much information to provide security to your buyers, and that is one of the tasks on top of the public relations. And that is the situation. You get the emotional people that just buy some junk tokens because they sound good, but you get also some diligent investors, and there are some traders that are just jumping in and they create certain performances that actually pull other people that are inexperienced into it, and then the whole pile collapses. I call it the journey to Jerusalem. When the music ends, there's just one chair left and there's one guy sitting on it. It's probably one of the top 5, but never one of the smaller ones. So we need to be very aware that this is also a kind of a sporty risk to go into it. The same as we have to take as venture capitalists. We have also some startups where we go in, where we do not know the outcome because we just like the people. But we need to know them a little bit better before we actually can trust them. So that is the situation for everyone who does invest into tokens.
Mm. I guess one of the key things is also that, I mean, we are standing on a moving platform. We have the technology moving, completely unknown where we'll go to. We have, as Juliana said, the legal situation, which is completely open. That wasn't the case necessarily with internet investing or mobile investing. I mean, the legal structure was rather clear. But these days, you don't know what kind of licenses you need from the regulatory environment. As Percy just said, you don't know if it's called a security all of a sudden. So the SEC is showing some interest. And all this legal framework is becoming very tricky. I mean, just think of tax changes like we had them announced in Germany recently, or not changes, but confirmation of existing tax laws that completely have the potential to completely screw up the DeFi economics.
And yeah, that's a big thing, Wolfgang, that you mentioned.
Absolutely, and I think eventually. I mean, some dreaming is always nice, but I don't think that a system where the regulatory environment and the tax collector feels excluded will stand a chance. It's all nice to talk about this libertarian idea of blockchain, but I think we have to move from DeFi to a more real fi, or whatever it's called eventually. Where all the advantages of the blockchain are integrated in a network that is compliant with laws, because that's the only way it's going to survive in the long term.
I wanted to add on what you said, Wolfgang, because I think many out there that also started with a structure that is a little more complex, for example, started with equity, and then there was a token emission at some point. They suddenly realized the word dry income and it hit them very hard. So this is something that is also for a retail investor that, of course, directly invests in a token that is not as relevant, but many professional investors are really now struggling a lot with over their status. For example, in Germany, are you asset manager or are you suddenly considered a commercial investor and so on? Which has a lot of influence how you're doing tax reports, how you file tax reports on your own level and on your investors level, and brings a lot of complexities along. And I think this is something that that takes time to clarify. So we are not completely there yet structure-wise all over the world to have the regulatory frameworks to easily invest in the space without even thinking about it. There are some structures in place, but I would say, especially in Europe, we're still in an evolutionary phase with that regard. The other thing is what you say, moving from DeFi to RealFi. I think we have the issue here, and that is one of the challenges that I wanted to add to your first question, Max, that you asked when we started. It is a lot of prejudice out there towards the space, and that is mostly caused by scam. That is caused because Bitcoin has been used on Silk Road, and that is the public cases. That is because Bitcoin consumes a lot of energy. How often did we all hear that? And people do not really get the full picture and can't really access it and assess it holistically. And all this prejudice also is a big challenge to the venture capital space that is focused on DLT currently. So overcoming those hurdles is exactly what we do here. It's really also educating that not everybody is just jumping on any token out there, but there are people that really try to find the raw diamonds that are mostly a little bit buried under the sand, and that you really need to dig out through all the noise that you have in the space and then help them to grow into a sustainable long-term project that really creates value. And there are also many investors in the space that are not interested in that long-term value, I usually make a hard cut between real venture capital in the space and just speculative investing. So this is one of the big differences. And I think in this panel, we have real venture capital investors that are also company builders and have this long-term approach.
Thank you for that perspective. I have two questions kind of segueing off of that. On the one hand, speaking about the regulatory things, do any of you have, for example, any investments that have you heard any pitches that you've decided not to invest in simply for the main reason that there was too much regulatory uncertainty for that particular business model? Okay, everybody's nodding.
Actually, we are an onshore-offshore construct ourselves. That is in order to sit in the right regulatory environments for your issuing. We have seen Malta, for example, was a risk because they invited everyone to come to Malta. At the end, they never performed with anything there because they have been regulated down. But literally, stay away from things that have to do with diamonds, with gold or something like that, because this is automatically considered a security, and you definitely need to file. You have prospect liability everywhere, and it doesn't matter if you be somewhere offshore with your issuing vehicles, it wouldn't work. So these are the things you should stay off, and there are many other things like tokenization of real estate is still also not so easy to handle. I mean, that is definitely a regulatory risk, because if that would move too fast into the blockchain, the whole system would collapse. That is actually true. And the regulatory bodies are right in being a little bit at ease if it comes to this situation. I mean, you can literally imagine we are now at a position. I mean, we are working on a virtual lawyer system, a virtual contracting platform that really signs notarized agreements. In order to overcome that, we have seen already that there are decentralized entities going around, digital entities, DAOs, and so forth, that are now condensating in form of like real companies in certain jurisdictions. So you can literally incorporate a company within 5 minutes on the blockchain and have your tokens in your wallet. It's actually a high-speed STO that you're doing there, literally to your like 5 shareholders. These constructs are coming, and they're coming now from certain governments where I can put the hat on as also working in Altem Group. Altem Group gives a lot of advice to international governments, and we know for certain that they are trying to understand, to be as fast as possible in integrating, because they see a big advantage in it. I mean, in the future, they can easily manage taxes much easier. They have much more transparency if it comes to the assets someone has and so forth. So for them, it's an advantage. but they're yet not ready. I mean, whenever you go to the authorities, you know that these people are probably sitting there since 30 years doing normal paperwork. And now we are hammering them with topics that we are here in this round discuss heavily, all these blockchain things. They need to understand the terms first. So we try to be with very easy examples, trying to get it closer to them. But I can tell you this is still a hard way to walk. And regulatory risk is after the scam risks, the biggest risk we have in those offerings. So we have to be very careful with things that are close to a security, especially if you're doing an STO with underlying stock. It's still stock. And also in that terms, the advantage of our approach is that we do the pre-IPO as an STO, but then later bring it over into the normal format as normal shares that are electronically traded on a regulated market. This is a thing that we had the ability to negotiate with the financial services authorities, but it was a long way to go.
I think that would have been the next question I had, talking about security token offerings, the regulation we see there. I mean, there's some countries that are moving quickly, some are moving slowly, especially within Europe. And the question there for me would be, would any of you consider making a pure token investment in a company if it was a full security token offering, in the sense that this token is really equal to equity? Or is there still I don't know, some other reasons why you might not take that route if the regulation was there?
Yeah, if it comes to regulation, if you look into regulation itself, then you have to look into the jurisdiction itself. In Europe, it's very difficult, to be honest. We have seen these constructions mostly coming from like British Virgin Island, Nevins and St. Kittens. They are currently things where it works. But the problem is also from the compliance perspective. If you are doing that, the best is to remain. You should diversify your investment. If you do a fiat investment into a token, that's a different story than you are having like a book of crypto that you are then placing into it. That is actually a trading desk related thing where you have like a book of multiple titles that you are managing that are mitigating the risk. But if you do if you bet on one single thing, you have bulk risk. That is a thing that I would never recommend doing due to the regulatory risk, because they can any moment they can stop the music and another chair will be taken off the game.
Maybe any other thoughts from the other panelists?
Just a general comment. I think people just underestimate on a legal and compliance side with how many like changes that is associated, right? Like, I mean, if we invest in a startup, like just pure equity deal with like similar conditions and just the country is differing, you know, then you have to talk to like several lawyers, and you can't even talk to lawyers that you work with your own country because they have to introduce you to someone because they don't have a license for the other country you maybe want to invest in. So they introduce you to someone else. And actually this comes along with lots of like legal costs, time. It's just, I think also like very, very inconvenient. And I think this is something that, because I come also from the startup side myself, so I would say I think I've seen a fair share so far of both sides to some extent, especially the early stage space. And from a founder side, I'm very sure that this is something that most founders just like underestimate, like by a lot. Also compliance, right? Because if you have a fund and you have several investors, you also need to justify like the type of decisions you make. So it just comes with a lot of like caveats, I would say, and that probably just takes some time. But generally, I think every good investor and venture capitalist, and I'm sure my fellows here would agree with that, that see great value and great opportunities will always adapt, right? And I think if STO investments for whatever reasons as one category like will prevail, and there's a lot of good reasoning for why the best companies in the future, or some of them will do that, then we will adapt. But this just, I would argue, just takes time.
So
yeah,
maybe one final question to everybody, taking a step back, looking at the environment we have right now, because we have about 5 minutes left. Benjamin, you just mentioned that it is already very difficult to make a normal equity investment into a different country. And considering that 3 of you sitting here are based in Germany, I think, and Percy, it sounds like you're a little bit more spread out. Are you happy with your choice of location? What are your thoughts on the startup environment, maybe in the location you are in right now?
Maybe just one sentence to clarify. It's not difficult. It's just inconvenient. Just to differentiate. It's all doable.
Okay.
It's just I would say inconvenient. Yeah.
So are you happy, Benjamin, with being in Berlin?
Yeah, I think so. I mean, I mean, I think it's interesting to see like how the whole shift with COVID maybe might impact that in the long run. I think it really changes the way that people collaborate with each other. Like everything becomes truly more decentralized working with each other, not just in the blockchain world. So I think that maybe makes it a bit more meritocratic in the long run, that people can be more distributed in the world, or at least contribute to that factor. Otherwise, I would argue ecosystems are just really important. I think network and ecosystems are very important. And most of the investors and VCs that I talk to, and this is something I get confirmed a lot these days, is actually most of the good deals don't come from like cold application funnels, but usually come through introductions for co-investments, right? And maybe then there's accelerators. I mean, we have some good applications, I would argue by now, that come through a cold funnel. And of course, the best in the world would be Y Combinator, because they're so famous that every startup in the world will apply to their funnel. But most of the VCs actually rely on the network. And that's why I would argue ecosystem is definitely crucial. And I think in Germany and in Berlin, the blockchain space is definitely one of the better ecosystems to be at this point of time. Those are my 2 cents of it, at least.
No, I would say that Germany has super good people. You find the best people in development often in Germany. And you have at least 1 or 2 two-man teams there that are really efficient, give a lot of punch. That is a good thing. The only thing is a terrible taxation environment and, of course, a regulatory environment on top of the EU level layer. That is the thing we have to work out, but that is actually also work for the venture capitalist in order to mitigate that. And I think we have already found our ways in dealing with it. And that's how we see it. Yeah.
I mean, one of the reasons why we set up shop in Liechtenstein, which is our corporate headquarters, is because they have this TVTG, this Token Act, which is quite advanced, and we believe it'll eventually spill over the rest of to the rest of Europe. But I mean, your question, Max, does it matter in which legislation a startup is based? Not really, unless it's as long as it is a sort of a secure low location, secure and stable country. I mean, we just invested in Switzerland, we just invested in Luxembourg. Actually, sometimes it's easier because you don't have to notarize your shares, so you save a bit of money in the process and save a bit of complexity. That's all fine. I don't think that STOs will change that or make it more convenient, because you still have this issue with security law that is still in the works, so to speak. So we're quite happy with the normal equity investing so far.
To wrap up, Juliane, your thoughts on this topic?
So I can confirm basically nearly all the points that you have mentioned. We have put a lot of effort into choosing the location and also the setup. And for Fund 1, it is definitely the most suited setup and very lean and very efficient. We're a German Spezial-AIF. So I am so far happy, of course, with the geography in the setup. There are some, as you already mentioned, there are some regulatory hurdles in Europe that are quite high and that apply also to smaller early stage funds. And sometimes it's excessive what you have to do. It's really excessive and costs a lot of money. And basically that scales, of course, when your fund becomes bigger. But for small funds, that is quite a challenge. So from that side, I would really wish for a clarification from a lot of officers on a really timely basis, because we see clearly that teams settle around ecosystems, as Benjamin said. And of course, you have, on the one hand, you have a very distributed team setup, mostly in our space now. So if we say we have a Delaware company, it doesn't mean that the team is not located in Europe. But usually an ecosystem mostly conglomerates around people. So it's really vital that we keep the possibility in Europe to be at the top of the funding list for international founders to really attract them, also to locate them, relocate themselves, to meet ecosystem locally and to grow it locally. As I said, distributed teams mitigate the trend significantly compared to general VC, but still there is a trend. And I would wish for that to change very, very fast, because right now I feel that many good people try to evade that kind of hard regulation and tend to move to other countries after they have started and tried it in Europe. And that is a sad fact at the moment. So
okay. I think that was some very good closing words to wrap it up, a little bit of the wishes for the future as well. And at this point, I would like to thank you all for your time for this panel. I'd like to thank all the people watching for their time. I think it was a very interesting, very fruitful discussion. I personally, at least, learned a lot of things, and I hope all the people